At the start of this example, there is clear confirmation of an uptrend with sustained synchronization between the indicator and price. It is then followed by a great demonstration of divergence. The price of this individual stock goes against the broad market where most stocks are falling. This means stock price is going against the market when there is a key reversal for most stocks in the market. The end result is a strong reversal as this individual stock eventually catches up with the sentiment of the majority of stocks in the stock market. During the development of this early bullish trend, there's a similar result happening, where divergence has price of the stock going higher while the majority of stocks in the market, as represented by the indicator, begins to decline. Then with the more recent pair of heavily bearish candles, price on this chart is getting back in sync with the movement of most of the stocks in the market. This demonstrates how divergence can be a leading indicator of sorts before a chart gets back in sync with the rest of the market to begin a new reversal. But this is just one single indicator. Even when there are great conditions in terms of divergence and synchronization, major reversals and continuations aren't always guaranteed. So it would be wise to also use other analysis methods and look at the broader context.